All right, today is April 20th, 2017. Today we have a very special guest, my friend Ralph Price, who is a private equity analyst from Northwestern Mutual. Hey, Ralph.
Hey, DH, how are you?
Good, good. Ralph, it's been a long time since I called you, and I'm sure you're very busy right now working in the office, if I'm not mistaken.
No, I'm actually hanging out at home right now.
You got some rest. Ralph, talk to us about private equity and this exciting industry.
Sure. So, I guess I'll just give a brief description about what private equity is and how my job fits into this. So, private equity is essentially funds buying up private companies. And that's very different from how you would think about your normal investments. You kind of think about stocks, bonds, and all those things are kind of in the public market sphere. But what we do is investing in, companies that are as small as your mom and pops to large private companies. Like, for example, I'll give an example of a large private company like Dell Computers. So I guess depending on where you sit within the industry, you focus kind of on large cap companies like that or on smaller, middle market or lower middle market companies.
Why would private equity companies want to buy such companies?
I think, first of all, so these private companies are usually run somewhat inefficiently, in some cases very inefficiently. So, the value add of private equity funds when they come in is they're able to find, first of all, companies that have great potential, and then they're able to take out all the inefficiencies in the system, whether that's management or how inventory is managed or logistically how the company is set up, or if there's way too much people employed. So, a private equity firm's job, and I think this is also what gives it a lot, kind of a bad stigma, is in the name of efficiency, you have to make some tough decisions. And so that's what makes private investing really attractive. And also, it's another part of it too is it's extremely difficult to source private companies as investments just because you have something called a complexity premium. Essentially, you have to employ a lot of resources in order to be able to analyze a company that doesn't have public financials. Whereas if you're investing in Apple computers, for example, you can look up Apple's 10K online and then be able to analyze all of their historical financials, but you can't necessarily do that for a private company. So you get paid a premium on being able to invest in something that's not easy to obtain.
And does the investment philosophy of each private equity differ incredibly?
Absolutely. So it depends on a lot of different factors. One is by industry. Some private equity firms have specialties by industry. Some will only invest in tech. Some will invest in consumer and retail. Usually all these guys have had years of experience within these different verticals. And so they'll only limit their scope to, those specific areas. And it also helps them to be able to source management teams that can fit within the companies that they buy up. So, for example, if you don't know anything about oil and gas, it'll be difficult for you to find an oil and gas CEO that would be good for the company that you just bought, let alone be able to understand the ins and outs of the industry and the company you're investing in. So from that standpoint, each fund has a different philosophy. And also, by industry, no industry is the same in the way you analyze them financially. So that's a big factor. And also, some funds, have a very set preference for the type of size of the company. Also, some funds don't have a ton of capital to be able to invest, or they don't have a large LP base, so they don't have as much resources to be able to invest in these multi-billion-dollar private entities, essentially. And so they kind of have to focus on smaller middle market, lower middle market companies that are somewhat profitable.
Could you talk to us about the sentiment of the owner of these businesses that can be forced to sell themselves oftentimes, or sometimes maybe they want to be sold to private equity firms?
Right. So, I think from what you just said, that kind of implies two things. So one, it's, a lot of owners want to eventually cash out their position in the company and are willing to give up their ownership and also control of the day-to-day operations. And then also there are some owners that, it could be like a family-run business. It's been in the family for generations and they don't necessarily want to give up control. So, it's an interesting dynamic because sometimes, depending on how good you are as an owner, you can set the investment up in a way that you want it to be. If you're a great owner and a private equity firm comes in and buys you up, they would probably want to keep you where you are. But if you're a bad one, then they'll pay you whatever they need to pay you in order to leave. In that dichotomy, generally, if you're looking at a company that an owner really doesn't want to give up control, then I think that everybody eventually has a price, or you just wait until the time is ripe, until somebody doesn't want to have to run their company anymore. But for the most part, they're pretty open to negotiating what would be a good purchase price for the business.
Talk to us about your peers. I suppose your peers are people with domain expertise in the particular industry vertical that the private equity firm is interested in. I'm assuming that a lot of college graduates who want to enter this field might have to maybe double major and study something particular, very specific to that domain that they're focused in. Is that how it works?
So for us, it's a bit different. So I guess the way that our group is set up isn't, how you would think about your traditional private equity firm. So I guess I should explain this in a bit more depth, but within the private equity sphere, there are a lot of different players. So the ones that you think about the most are the ones that directly find these companies and invest in them. Those are called buyout funds. And, their job is they're the ones cold calling management teams, finding the right companies, and then screening them to see if it's worth pursuing. And those are typically the guys that, get compensated quite heavily for what they do. And then there's what we do, which is kind of, I guess friendly capital. So we are what's called limited partners. And so we're the guys that invest in these private equity funds. And then when it comes time to be able to invest in individual companies, we act as a private equity fund ourselves, in that we invest our own capital alongside these buyout funds. So the people that work in my group, you don't necessarily have to have certain industry expertise. You just need to learn how to analyze a company. And, in time, that doesn't become that difficult to do. I think the most important thing for somebody in the role is you need to be able to understand financials. You need to be able to understand how to model, a leveraged buyout, where if you're leveraging up a company and with a lot of debt, what is your guaranteed return at the end of the day? Not guaranteed rate of return, but what do you expect to make out of this transaction? So you need to be able to be comfortable with your accounting, your corporate finance, jargon. And I think you need to be able to understand the industry well enough to be able to get on a call with another private equity sponsor or an investment bank and talk with them about the deal as if you're equals, because at the end of the day, you're both investing in this company together, so you have to keep up with everybody's pace.
Talk to us about the sources of funds. You mentioned leveraging up a company and borrowing a lot of money.
Right. So, I guess the best way to describe private equity investments and buying out a company is think about if you want to buy a house. And so, part of the way that you're capitalizing your transaction is you're borrowing money in order to buy that. And then you're also putting up your own capital, which is equity. So, most of the time when you're buying up something, you're going to borrow money in order to do it. And I'm not going to get into the specific financials for why that makes sense, but most of that transaction is going to be debt funded. And so when you think about that, you have to think about, one, how much debt can this company handle? Or, for example, if you're buying a house, how much debt should I borrow in order to buy this house? And two, is this company going to generate enough cash to be able to pay down this debt in the future? Or, in the analogy that I gave you, is the rental payment or whatever it is, whatever your stream of income is the rental payment going to be able to pay down the debt I just put on this house, so that down the road, there's significantly more equity and I can sell it for a healthy profit. So that's kind of how you would think about funding a company.
For those that are tuning in, intuitively for me personally, in terms of personal finances, I don't actually have all the money to buy a house, which is why we borrow money. And that can be also a reason for why private equities borrow money, because it's kind of hard to sum up all the money up front in just pure line cash. Would you say so?
Oh, absolutely. So, a lot of these funds, I'll give you an example. So, like an average fund, let's say, is about, $1 billion of capital. But, that $1 billion of capital isn't going into one specific investment. You have to think about diversifying your portfolio. So say, the way that it's set up, you can't invest more than 15% of your fund. So, out of 100 million, you can only use 150 for this specific company. But this company, its value to the seller is, say, 400 million. So in order for you to fill that gap, you need 350 million in debt, essentially, because you just don't have enough capital to be able to take this down on your own. And that's kind of where we come in. We fill in that debt gap, and also if a fund doesn't want to commit as much equity as they would like, we come in and also fill in that equity gap as well.
You mentioned you need to know knowledge on sound financials, how to read a financial statement, how to determine whether or not this company is going to generate enough cash to pay down the debt that I borrowed to buy the company. Could you talk to us about where that experience comes from? Do you learn that in college, reading textbooks on accounting, or is that something that you do an internship with, or I don't know, give us examples of how one can be a pretty good seasoned reader of financials so that when they go into the job or when they're applying for jobs, they can be very qualified?
So I think for me personally, the best experience I've gotten was through extracurriculars in college. As both of us have experienced during our time at Notre Dame, there's great organizations on campus that allow you to do a lot of hands-on work with financial institutions where, they teach you how to model, they teach you what to look for in financials, how to read it. But I think, if you're somebody who wants to get into this in a relatively quick amount of time and you don't have a lot of resources that you would get from a college, one would be to find a class or online class or online modeling course that teaches you basic accounting. You can find an accounting textbook and read through that if you want. But I think the best thing you can do to get you prepared for this job is to be able to learn how to model. And that's mostly, I didn't learn any of that really in class. Modeling was mostly done through all the clubs that I did on campus, but there are a lot of online resources through like Breaking into Wall Street or Wall Street Oasis that walk you through how to build simple valuation models or very complex ones. But that would probably be the best way to get a start. Now, if you really want to get more engaged with it, I also would recommend that you just go through like a regular financial statement for a company that you know or you like. Like you can go through Microsoft's financials and then go through the income statement, the balance sheet, the cash flow statement within their Form 10K, which you can find on their website. You could probably find that on like their investor center or something. And just try to understand what each line item means. Like what does net income? How do you calculate net income? How do you calculate operating income? How does it kind of flow from your income statement to your balance sheet to your cash flow, and what all these numbers mean? So I think that's probably the best way for anybody to really understand how to understand financials is to just keep looking at different companies and try to understand what each of the line items mean. And typically you can go to like a forum, for example, like Seeking Alpha, and some people will just have a general discussion on the comment section about, what's important and what they look at, when they're trying to come up with their investment thesis for a specific company. But those are just some of the things that I would recommend.
So I know you personally from college, and I know you've always been interested in finance. For those people that are kind of unfamiliar with finance, how can they get a quick exposure to finance in middle school or high school to better gauge whether or not finance is a good fit, first of all, and whether private equity is a good fit for them personally? Because there's a lot of good jobs within finance that you can pursue.
Oh, absolutely. So I think for finance, I think that, I think how all kids get started with trying to understand how to invest is like setting up a small portfolio that your parents give you, or your grandparents or aunts and uncles or whatever. And typically you can pick stocks, but I think that's a little bit, that's kind of like a blind shoot, because you don't really understand the fundamentals of a company and, whether or not the stock that you pick was a good choice or not. But I think, for somebody who, wants to understand whether or not finance is for them, I think first of all, you have to know what the job entails. And I think any finance job, first and foremost, requires you to be comfortable with a lot of obscure data, because, like, if you're working as an investment banker or in trading or private equity or asset management of some sort, people are going to give you a lot of different files and a lot of different numbers, and most of that stuff isn't even important, but you have to be comfortable with looking at large sets of information and then trying to understand what's important. I think that's first and foremost. If you can get comfortable with that and you kind of enjoy that stuff, then you should look into finance. Second, you really should want to understand what makes companies great and what makes companies good investments. When it comes to an investing role, whether or not you want to be in private equity or hedge funds or managing money for, wealthy individuals in a private wealth management type setting, I think it's really important for you to understand what value looks like. That's second. And I guess for private equity specifically, it's a bit of a different beast. It's a bit more long term than, how you would think about hedge fund investing or being a trader. A typical private equity buyout could last for months. And sometimes, like, your deal will die after you put months of work into it, and then either you get outbid or the owner doesn't want to sell anymore. And down the road, it becomes open to you again. So you need to be also comfortable with just being patient and overall not being too committed into any single deal that it clouds your judgment on what makes it a good investment. Because some people have a bias when you're putting a lot of effort and a lot of time into something, and you typically just want it to get done because you put a lot of time into it. But when you're somebody who's managing money for other people, you can't have that bias because that clouds your judgment on what's a good investment. So, those are just really three key things that you have to think about, if you want to work in this industry.
We're going to be talking about your interview process, and we're going to go beyond traditional job descriptions and sort of things that HR would talk to you about. Could you talk to us about the interview experience and what it was like?
Sure. So my first round interview was at Notre Dame. It was an in-person interview, and actually, I don't think my specific interview was like a normal interview, just because one of the projects that I had worked on, and this organization, SIBC, we did this project where we got to actually work with a private equity firm by the name of GTCR in Chicago, and we got to work on a leveraged buyout of this company called Kforce. And it just so happened that my interviewer, he worked directly with GTCR as part of kind of our sponsor relationship, and GTCR happens to be one of our best sponsor relationships. So most of the time I actually just talked about the project that I worked on. And he mostly asked me about what was the analysis that you did for K-Force? What was the leverage level that you put on this company? How did you structure the debt portion of it? What was your projected invested rate of return? Why did you eventually turn down the deal if they were to pursue it? So those were some of the high level stuff that I was asked, and then I got asked some basic accounting and valuation questions that you would typically see in like a investment banking interview. How do you calculate, weighted average cost of capital, which is really not relevant for the job, but I just got asked, some random accounting questions. When I got to the Super Day, most of the questions were mostly about how do you think about investments and how do you think about good companies. So for private equity, there's a very specific criteria in which you assess what a good private equity investment looks like. Because at the end of the day, cash flow is the most important metric that you assess a private equity investment. Because you're putting a ton of debt onto a company that you're buying, you need to be able to generate enough cash that, you're able to pay that down, and then you're able to sell the company off in a better state that you bought it at. So, most of the questions that I was asked were, like, how does a company go bankrupt even though it has positive net income? How would you capitalize an oil and gas company, or at least how would you analyze an oil and gas company versus a consumer retail company versus a tech company versus, all these type of different businesses. So I think most of the questions are going to be centered around how you think about businesses, because that's exactly how it was for me. And then at the end of the interview, they gave me a case study, and it asked like 5 very simple questions. One was, what are the strengths? What are the weaknesses? Would you invest in this company? If so, would you invest in debt? Would you invest in the equity? And if you're also thinking about, if you're thinking about a debt or equity investment, those are also very different things. So, one, you need to understand the industry, which is 90% of, or at least you need to understand companies within the industry, which is about 90% of the questions they ask. And then two, do you understand the numbers behind it?
Let's talk about your peers, where they come from. Are they similar to you at all in terms of background? And also, what makes them good or terrible to work with in a private equity setting?
Sure. So I think everybody is very similar in our group. Almost everybody has a finance background. Actually, thinking about it, every single person has a finance background. I think that mostly is due to the fact that the job requires you to hit the desk right away. So there isn't really much of a training program or an easing in period that you would see in like an investment bank, where there's a pretty robust training program. Like the first day that I got there, my boss gave me a deck, which is, a book that an investment banker makes, which is like 50 to 60 pages explaining the business. And he told me to analyze that. So everybody that comes into the program needs to have a firm grasp of accounting and finance to begin with. So everybody has that checked off the list. I think what makes a great analyst is somebody who will want to think, general competency is important. You need to be able to work quickly, to not make a lot of mistakes. I think that's kind of incumbent in all finance jobs, is you need to have very strong attention to detail. So those are just kind of basic skills. I think what puts you above where everybody would be in terms of what differentiates you is, one, are you somebody who's willing to run a process by yourself? Are you willing to get on the phone with a sponsor, and can you talk through a deal with them and have almost the same understanding as they do? So that's one. And two is, how you think about investments itself. Because I think part of the job and part of what makes my job difficult is it gets a little difficult for you to form your own thought when you have banks and private equity firms that already give you all their investment materials to begin with. And when you're somebody who wants to have a clear understanding of the company on your own, you get clouded by information that you've already gotten. Once you read through like an investment banking pitch book or, a private equity firm's memo, then you already know what they're thinking about. And so you kind of anchor your thoughts on what they have. But I think if you're a great analyst, you can get rid of all that noise and you can approach this transaction with a very clear mind. And how that's shown is, do you have good questions that kind of push back on the thesis? For example, there was one deal that we did, or we ended up turning it down, but we worked with a very large private equity firm out in California. And the business was it was essentially buying up insurance liabilities in Europe. So one, trying to really understand insurance companies is difficult to deal with in the first place. And then two, you also have to analyze the economic conditions in Europe. So that's very difficult. So it's really easy to kind of just sit back and have the firm explain to you what that is, or do the analysis for you because they've worked on this for so long, or you can take the time to really dig into it and understand it yourself. So I think somebody who will succeed in this job is somebody who takes, a lot of time to do their research, and, they don't really care how much time it takes as long as they get there. On the other hand, what makes somebody a bad analyst is somebody who kind of just relies on what they're given and is just there to crank out work, essentially. Because the nature of our job requires us to be able to do so many deals at one time that it's really easy for you to just plug in financials into a template, spit out a nice number, and then say we should do the deal, which is not what you're hired for. Part of the time obviously is to get the deal done, but it's also for you to make a good judgment call on whether or not that's a good decision. So that's one makes a bad analyst. And two is somebody who doesn't know how to conduct themselves professionally. Most of the job, once you start to gain the trust of your boss, is to be able to talk to management teams, talk to private equity firms, talk to banks, and to not sound uneducated in terms of the deal you're working on. And somebody who doesn't succeed, and I've never seen this from any micro analysts because they're actually all really good. But in the past, there are some people who have not conducted themselves professionally and who aren't willing to take that extra step in doing their diligence. So yeah, those are just some things.
Gotcha, Ralph. You mentioned the point about clearing any seeping bias that comes from pitch books. And I'm not sure if the audience members are familiar with that dynamic between other private equity firms and your private equity firm, and also the investment banks that come in and try to sell some business. Could you talk to us about that dynamic?
Yeah, absolutely. So, an investment bank's job is to represent the company that they're selling. So a company will hire an investment bank in order to run a marketed process. And how that works is, for example, let's take a recent example of how that dynamic would work. It's not necessarily in a private equity sphere, but take Snapchat, for example. Snapchat hires Morgan Stanley and Goldman Sachs to be able to market Snapchat stock around the world or around the country, and then gathers up investors, engages public interest on whether or not, this would be a deal that can get done, and two, at what price can it get done. So, banks will, it's a sales pitch. And when it comes to private equity investing, banks do the same thing. They are hired by a company that's selling, and that could be the company itself who's trying to sell themselves, or It can be a company already owned by a private equity firm, and that private equity firm is trying to sell this company to another private equity firm. So in order for them to do that, they create what's called a pitch book, which is like that's a monstrosity of a document that it's mostly just very useless information, depending on what bank works on it. It's just very fluffy words to describe what's great about this company. And, your job as an analyst is to be able to understand what information you're missing. One of the simplest tricks of an investment bank, what they would do is when they're showing you like historical financials, for example, they will only show you historical financials to when that would look good. So, if you're looking at revenue and you're trying to understand if this company did poorly or kind of well in the recession, they'd be happy to show you those financials through 2007. But if they didn't do too well in that area, they would cut that off at like 2010 and be like, this is how we did from 2010 to 2016. Did fantastic. But then you gotta ask them like, hey, so what happened before that? And kind of prod them on that. Because once you read these pitch decks, you kind of get a feel for, there's a lot of missing information that you really need to understand in order for you to make a good decision, because they'll try to fluff you up with really trying to sell the business, that you need to be able to just look at that with a very skeptical view.
So you mentioned on your first day of work, you had to read through a 50 to 60 page deck, which is pretty intense to be a first task. Could you talk about your work-life balance at the firm and a little bit of a rundown of your day-to-day schedule?
Sure. So it's actually not bad. I think I come into work around 8:30 or between 8:30 to 9, and then I'll finish up everything I have to do by 6:30 or 7. That's typically my day. So what is that? On average, a 10 and a half hour day. And that's really not that bad in comparison to like a large private equity buyout shop or an investment bank. What I do first thing in the morning is, check emails to see if any new files have come through for whatever company we're looking at. Another thing to note too is when you're looking at a company for an investment, the sponsor who's selling the company or the investment bank who's facilitating this transaction opens up what's called the data room. And what a data room is it's just a dump of all information that the company can produce. And it ranges from really important things to audited financials, quality of earnings reports, how much money they spend on facilities and whatnot, really important stuff, to really mundane stuff like a receipt for like office supplies. Like pretty much anything you can think of goes into a data room for a company that's being sold. You are legally obligated to disclose any and all information that you have as part of the transaction. So every morning I come in and see if the data room has been populated and, download all the stuff that I need to look at for the day. And once I go through all that stuff and email whoever I have to email for the morning, then I start reading about whatever company we're working on at the moment. And that can be one company at a time, or that can be 5 companies at a time. It just depends on the time of year and how active private equity sponsors are when it comes to sourcing deals, because we turn down a lot of companies because it doesn't necessarily fit our investment philosophy. But, sometimes we'll pursue a few of them, and we'll typically work towards them for the next few weeks to a month or a month and a half. That's typically our average time that we spend when it comes to a direct equity deal or a high yield or mezzanine deal. So I'll start reading through all the material for that for the next probably 2 to 3 hours. I like to think that I read quickly, but compared to my boss, I read pretty slowly. So to get me through like a 50 to 60 page investment banking deck, that'll take me like 3 hours probably, just to really understand what's in it, if there's anything important, if there's anything we're missing. I'll read through that stuff, Then I'll make a question list of all the things that I don't understand or that we need information to. And that'll take me like another hour or two just because you want to really craft a good question list, because if you craft a bad one, the management team and the banks just won't give you a good answer. If you ask a question as a yes or no phrase question, they'll just say yes or no. So you need to really be able to ask good questions like, please explain this, or please provide numbers behind this. That's probably how you get around people just BSing you. And then grab lunch around noon, read up some more stuff for the rest of the afternoon. I'll talk to my boss probably for like half an hour on any specific company we're looking at. Sometimes we'll get on a call with a bank or a private equity sponsor about a deal. It could be a debt deal for a publicly traded company, and that doesn't take a whole lot of time. But if it's a direct equity investment where we're buying up a company, it takes a while for us to be comfortable with those things, and therefore that call takes like an hour to 2 hours at a time. By the time I get off a call, it'll be like 4 o'clock, and then I'll just spend from 4 to 7 wrapping up loose ends on modeling or making a memo for something or reading news, stuff like that.
Ralph, I would say that the private equity industry is very competitive in terms of its competition for talent. Are there any particular recommendations to high school students or college students who want to break into private equity? Maybe advice on which majors to pursue, also maybe which colleges to focus on in terms of their application process?
Sure. So in terms of the education you can get if you're already in college, the most important classes you can take are finance, accounting, consulting, if there's a management emphasis within your business school, or economics could work too. I think the most important thing is how much hands-on experience do you have? Most private equity firms, so for us, since we're only an LP investor, we don't require nearly as much specialized knowledge or as much experience as a buyout shop would. So you can actually do our job right out of undergrad, which is typically all of our analysts have come out of undergrad and done this job. We do have associates that at that stage you have to come from an MBA program in order to do that, because that's kind of standard practice within private equity. But the most important thing is having good hands-on experience, because, like I said, you have to hit the desk right away, and there's not a whole lot of time for you to really ease into it. You have to be operating at a pretty good speed right when you start. So there's that also. But if you want to work for a private equity buyout shop, so like a Blackstone or a Carlyle Group or a KKR, which are multi-billion-dollar private equity funds that buy up extremely large companies, you typically need banking experience first, since most of them only hire bankers for the most part. So you need to work in banking or management consulting for 2 to 3 years, and then you start recruiting for a private equity job, and then you kind of do that for a few years and then go to business school. But, I don't think the school matters all that much. Obviously, a lot of private equity funds recruit mostly from top schools, as you would expect. I think that's kind of a pretty common theme in finance. Typically, you would see a lot of Ivy League recruits, and that's not abnormal. But any top school will get recruited by private equity funds for the most part. But I think more important than the school is how much experience you have going into the job. And as long as you can get through case studies that they give you, you're comfortable with modeling. If they give you a set of financials, how fast can you dissect that? That's also really important. And that's more important than your undergrad education for the most part.
Ralph, we can't thank you enough for joining us today. Some of the audience tuning in will identify their passion with your occupation and pursue that as a goal. And that's always a great feeling to be having. Now, if you could give one final message to those people watching to become a private equity analyst, maybe perhaps even at your firm, what would that be?
So I think if you want to work in this industry and you want to do private equity investing overall, or just investing overall, I think you need to understand whether you are an independent thinker and somebody who likes to really question a lot of things. I think part of what makes a great investor is somebody who doesn't just take what's given to them, without a whole lot of verification. The hard part about the job, and also the most rewarding part of the job, is being able to have to argue with somebody about the merits of the company and what makes it great or what makes it really bad, and why you shouldn't put the money that you're investing for other people into this company. Because at the end of the day, what you need to think about is every fund, manages regular people's money. And you need to take that job really seriously in order for you to be successful, and also whether or not you're comfortable doing that in the first place. Another important thing is, are you comfortable with a lot of uncertainty? Because, finance is just as much art as it is a science. It's, you making guesses a lot of the time about where you think this company is headed. Obviously, you're making educated guesses about, where this industry is trending, whether or not, the product that your company is going to, stay competitive in the market for an extended period of time, whether or not the management team that you put in is actually going to carry through with the plan. So there's a lot of uncertainties that you won't know how those things turn out. And so I think another thing too is, how comfortable are you with not knowing the answer most of the time, but still being able to analyze a company really well and putting together a good thesis that you can actually protect your downsides no matter what the worst case scenario is that you put forth. Those are just two main things to think about is, do you like to understand companies? Do you like dealing with a lot of information, a lot of data? Are you comfortable with a lot of uncertainty? And two, are you comfortable with potentially also losing money in one investment or several investments? Yeah, those are just some things to think about. But if you, at the end of the day, if you like understanding businesses, I think this is a great field.
That was Ralph Price. Hope you make a lot of money, Ralph.
Appreciate it, DH.
Talk to you soon. Bye-bye.
Bye.